All right, we are still on chapter 6, and we are looking at some special issues for step 3. One of those issues is it a seller, principal, or agent? Okay, so performance obligation, if it's a principal, the principal is going to provide the service. Okay, the agent may just be facilitating the sale. Okay, then recording the revenue, the principal would record the whole sales price paid by the customer and then recognize cost of goods sold. An agent would only record their commission. And this is one of the reasons right here is why there's a lot of new revenue recognition laws, because there were some of these places like Expedia, um, like if you go through a third party to book a hotel room or a flight or something like that, they were recording all of that as revenue, but they were just the agent. There was, you know, they shouldn't be recording as much. So they give us a problem here, and we can go through this and kind of look at it from the principal's perspective versus the agent. So there's a lot of verbiage in here, but let's let's jump to revenue was 290. If it is the principal, they'll make the journal entry. They'll record all of the sales revenue. 290 less the cost of goods sold equals the gross profit of 50. If it's an agent and all they are is helping facilitate it, then they would just record the 50. Okay. So we would not have to go in there, not have to, because that's what they would do. They would record the total sale, and then they would also, they would take out what they have to pay, but that made their sales look really, really big. Okay. All right. Moving right along. Time value of money. We just did a whole chapter on time value of money. And if you are an intermediate accounting student right now, you're probably in my financial management class right now. And we spent weeks on time value of money. So you should have those skills mastered. Okay. Sometimes there is a financing component. They may want to make it look more like sales, because that's, when you're doing your income statement, that's way up there in the top. If it's a financing element, that's an interest revenue that goes down in that other gains and losses. Okay. Other income and expenses. Okay. They would rather all of that be in the sales because that makes their sales number look better. Okay. So they're going to give us an example here. They said on January 1st, 2027, TruTech enters into the contract with GameStop stores to deliver for 240 TriBox modules that have a combined fair value of 960. Prepayment case, GameStop pays TruTech $873 on January 1st, and TruTech agrees to deliver the modules on December 31st, 2027. Okay, we're looking at a whole year here. We're looking at January 1 of 27 all the way to 12/31/27. Okay, so on January 1, we are going to debit cash and credit deferred revenue because we have not delivered them yet. Okay. And then they said they were going to pay us 960. We could go through that. Uh, they used the present value here, the present value of one period, 10% was, and they calculated, you could see that the 87.3 multiplied times 10% gave us $87. So we've earned we have some interest expense related to this. Okay. So we are going to debit that interest expense. We're going to debit the deferred revenue that came from right there. And then we will record sales revenue of $960. Okay. Then here is the receivable case. So TruTech delivers the modules on January 1st, and GameStop agrees to pay $1,056 on December 31, 2027. So we would have debit a note receivable, credit $96 to discount on notes receivable. That is just almost exactly like discount on bonds payable or something like that. It's a contra to that notes receivable. the net of that receivable right now is 960. Okay. When we get the cash of $1,056, we are going to debit that discount, make that go away, credit the 1,056, make that go away, and record $96 of revenue. Okay. All right. So sometimes the seller purchases distinct goods or services from a customer. The fair value of those goods or services, the seller accounts for the purchase under a separate transaction. So they may pay more than the fair value of those goods or services just because they're getting a better deal. There might be something in there like a sweetener for the deal, but we want to make sure that they are only recording revenue when it is earned, okay, and not some other stuff, okay? Various approaches to estimate standalone prices. We could have adjusted market assessment approach, expected cost plus margin approach, or the residual approach. Okay, so I think they give us an example. Assume that TruTech sells 1,000 try boxes with 1 year TriNet subscription for $250. Okay, $250. The standalone price is $240. And they're using the residual approach here. Remember, we did one like this, but we were using like the fair market value of it. So that adjusted market assessment approach is what we did. Now we're doing residual. So we don't really know what the subscription, would be a situation where we did not know how much the subscription would be standing alone. And we would just account for it as the residual. So total cost, total price of the TriBox and the TriNet subscription, 250,000. We took the 240,000. That's just the 240 times 1,000 boxes. Same here. That extra $10 for all 1,000 units will go into an estimated standalone price for the subscription. Okay, do they do the journal entries? Yes, they do the journal entries. We are going to debit accounts receivable for 250,000, credit sales revenue of 240,000, then credit deferred revenue on that 10,000, and we will gradually earn that $10,000 over that 1 year. Okay. All right, let's jump down here. We are looking still at some more special issues in regards to step 5. Just a quick reminder, these are the 5 steps that we are going through. Well, it was there in the last video. Okay, I guess it's not. Okay. All right, so some of the common arrangements can be complicated because of revenue recognition. So we could have some licenses, franchises, bill and hold arrangements, consignment. If you go and you put some product in a consignment store and they're selling it for you, then that is still your inventory. Even though you don't have control over it, that is still your inventory because it is a consignment arrangement. Okay. And gift cards. Gift cards are a big issue. Okay. Licenses would be, you know, it would stand alone. One of the example I have of a license is Becker. Um, when you take the CPA exam, Becker is one of the best. I passed the exam with using Becker. I really liked it. They were really good to me because I was going through a lot at that time. And they extended my subscription. That's what they called it basically. But I didn't get like a whole bunch of books and a whole bunch of stuff, but I got a subscription. And the great thing about that is that Becker always was keeping up with any changes in the CPA exam. So if anything changed, I was already getting those changes in what I was studying. Okay. So, but it was just a license. I can't log into Becker now and access CPA review materials because it was only for a certain time. Okay. And they've got music downloads. We buy music on iTunes and different things like that. Okay. Some other licensing, we might have some trademarks, logos, brand names, franchise rights. Okay. lots of those special issues. Okay, franchises. Franchises, this would be like your McDonald's, Chick-fil-A. Um, and you buy a franchise, you sort of buy into that because like that brand is already established. We know for a fact that probably most of the McDonald's ice cream machines are probably not going to be working. But we also know if we go to any Chick-fil-A, those waffle fries are going to be the same, right? So like you don't have as much that to do to get a business off the ground if you just buy a franchise. Okay. All right. We also have bill and hold arrangements. This happens, I kind of mentioned it in the previous video. Sometimes this can be used to perpetrate fraud and recording sales revenue when there really wasn't any revenue and they planned on returning it in the next like in the next period. I use the example, they'd make the sale in December and then they'd return it in January and then it looks like you had a sale. If there was a huge return from a big sale in December, most auditors are going to probably make them back that out and not let them claim that as revenue because that wasn't really revenue. Now, if they do, like there could be a legitimate reason, like say you're going to open up 100 McDonald's franchises, you might not have the warehouse room to put all of the equipment that's going to go. So if, you set that purchase up like, hey, I'm going to buy all this from you, but I have nowhere to put it. Can you store it in your warehouse? You can do that. They do need to separate it physically from the rest of the warehouse and all the other things are for sale. They need to know they have risk of loss on that, and that can happen, but it does have to have some very special um, controls over that. Okay. Um, Moving right along. Consignment arrangements. This is where we put an item into a store to sell on, and they're doing the work for us. So they're not going to make, let's just say, I think there's some furniture stores that probably do this. So let's just say, there's a couch for $500 and they are going to have to pay the consigner 400 for that, and then we as the shop, getting the consignment revenue of $100. It was kind of that like that one we just did at the beginning of this video. We can't, that person selling that can't do a revenue of 500 and then back out what they pay to the person that actually owned it. Okay, they can only record that $100. Okay. There's a lot of those concept checks. Okay. Then we have gift cards. Gift cards are a deferred liability. They are like unearned revenue on any company's financial statement. And as soon as that gift card is redeemed, revenue is recognized at that point in time. Okay. Then we have financial statement presentation and disclosure of revenue items. We have some special things for each one of our statements. Income statement, we're looking at bad debt expense. Bad debt expense could be estimated based on what's happening. That needs to be disclosed. Interest, if there is those financing arrangements, we need to disclose that. The balance sheet, if we have any contract liabilities, contract assets, all of those things need to be disclosed. Okay, as much as we can disclose as possible. Okay. So here we are kind of coming back to summarizing some of the special issues regarding revenue recognition. Okay. So I'm not going to, we just went through 2 videos of going through all these, maybe more than 2 videos, but these are really good summary slides right here to look over right before you walk in to take your exam. Okay. And that's all for this video. I'll see you in the next video.